asset class to trade is your currencies. Yes, because I mean, essentially, we're just exchanging one currency for another. It's actually leverage that makes the difference. All right, so volatility is measured with many tools, but the most common one is to use standard deviation, as well as our Bollinger Bands, which we will be talking about here a little bit later. Funnily enough, you know, when I started trading 16 years ago, I didn't have a clue, right? So my first indicators that I was using on my charts were either moving averages and Bollinger Bands, but I didn't have a clue how to use them. But let's start off with standard deviation here. And standard deviation is the most commonly used tool to measure volatility. And what it does is it measures the difference between the actual price and its average value, meaning that what is the price doing now compared to what it does on average. And the larger the volatility, the higher the standard deviation. And standard deviation is used to measure the price variation of a security and hence its relative risk. So something that has a high standard deviation value is more riskier to trade with than something with a low standard deviation value. So basically how we would interpret this, and I'll go and take you to the MC5 and show you what I mean by this. Standard deviation provides estimate for expected price movements, meaning that you know, it is giving you an idea of how much this instrument moves on average. And price moves that are greater than the standard deviation average, they show above strength or weakness. And these moves are actually used to overspot, overbought, oversold conditions within the market. Okay, so basically the main point here is that standard deviation, and let me just show you guys where you can find it. Now, if you go to your trend folder in your navigator, you can also go upstairs here to insert indicators, trend indicators, and you will go to your standard deviation. And you can just drag and drop it from your navigator if you want to onto your chart. Now, the parameters here, the look back period is standard, it's 21. You can pick your color of choice. Levels, we don't need levels, so we just press OK. And this is pretty much what it looks like. Now, I've got the euro dollar here on the 4-hour chart. And you can see here that, you know, usually, you know, we can expect the euro on the 4-hour chart for the last 21 periods. It has moved, let's say, roughly about 48 pips. You can see 0.00848, right? So this is giving me an indication of how risky it is to trade the instrument, first of all, meaning that if I compare this to an exotic currency, let's say, I don't know, dollar rand, for instance. If I put the US dollar versus the South African rand, you will see that, remember, the euro was 0.0048. So standard deviation here is 0.21665. Okay, so it has got a way higher standard deviation, meaning on average, it moves way more up and down its average value over the last 21 periods than the euro, right? So obviously this currency is way more riskier to trade than the euro, right? Because it moves more up and down. Now you can see here when we reach very extreme price levels, and you can see this, I mean, how do you know when standard deviation are at extreme levels? Well, you can always zoom out, yes, using the zoom out button on your standard toolbar. And you can basically see here that, you know, okay, if I take the average tops here, let's say over the last couple of periods, you will see that, you know, this is way out of proportion. It has moved way more than what it does on average. And when it gets above at these peaks, it's almost like an overbought scenario or oversold. You know, this can happen on the downside as well. It's just measuring volatility. It's not measuring direction of any means. But you can see here super high standard deviation. It's almost like an overbought scenario. So basically what it's telling you here is that at this point in time, it's probably not the best time to go and buy it. Okay, buy the dollar against the South African rand because it is at extreme price levels, and more than likely we can see a deeper style correction, which obviously it did. Going back to the euro here, I think you'll see it also here, but this is now on the downside. Yes, so here we had the market really, big volatility. You can see the spike here in our standard deviation, and it got to a point where our standard deviation values were just so high that it was telling you this is probably not the best time to get into a short position. I know the market is coming down, but more than likely from here on out, we will see a bounce in the market as we did. And then when it corrected, then we get into the position. Okay, so standard deviation, it's a wonderful little tool to measure. It's a pure volatility indicator. And you can also use it for breakouts, when something breaks its trend line or when it breaks out of a consolidation period. You will see a spike in volatility, meaning that it's giving you confirmation that this move is quite valid. And here you also, here we had a beautiful little consolidation area, almost like a wedge. Yes, as it broke out, you saw increased volatility as the market broke out, and this was just giving you confirmation as well. Okay, so standard deviation, most commonly used tool. It's a wonderful way of measuring the relative risk of an instrument. And then we have our Bollinger Bands. How many of you